Two personalization AI-powered platforms can analyze an investor's financial situation, risk tolerance, and goals to create personalized diversification strategies. This level of customization ensures that each portfolio is designed to meet the unique needs of the investor, rather than relying on generic, one-size-fits-all models. 3. Continuous learning and adaptation. Machine learning algorithms can learn from historical data and continuously adapt to new market conditions. This means that AI-driven platforms can improve over time, making more accurate predictions and offering better advice as they gain more experience. Challenges and considerations of AI in diversification. AI and machine learning offer significant advantages. There are also challenges to consider. Data quality. AI relies on high-quality data to make accurate predictions and recommendations. Inaccurate or incomplete data can lead to flawed conclusions and potentially risky investment decisions. Overfitting. Machine learning algorithms can sometimes become too focused on past data, leading to overfitting where the model works well with historical data but struggles to adapt to new, unforeseen circumstances. Lack of human intuition. While AI is excellent at processing data, it lacks the human intuition that can sometimes make a difference in complex, unpredictable markets. In some cases, the combination of AI insights and human judgment may be the best approach. Conclusion. The future of diversification. AI and machine learning are transforming the world of investing, offering new opportunities to optimize diversification strategies. By leveraging the power of these technologies, investors can build more resilient, data-driven portfolios that adapt to changing market conditions in real time. However, it's important to balance the efficiency and precision of AI with human oversight and intuition to ensure that portfolios remain aligned with long-term goals. The role of technology and automation in diversification. The past. Managing a diversified portfolio required substantial time, effort, and expertise. Investors had to manually track market conditions, analyze data, and adjust their portfolios regularly. However, with the rise of technology, the landscape of investing has been transformed. Technology and automation are now at the heart of modern investing, making it easier for both novice and experienced investors to build and maintain diversified portfolios. In this section, we'll examine how new technologies like robo-advisors, portfolio management apps, and automated investing tools are simplifying the process of diversification, enabling investors to make smarter, data-driven decisions with greater ease and efficiency. 1. Robo-advisors. Automating diversification for the masses. Robo-advisors are automated investment platforms that use algorithms to create and manage a diversified portfolio based on an investor's goals, risk tolerance, and financial situation. These platforms are powered by advanced technology that analyzes large datasets, allowing them to make optimized decisions without human intervention. How robo-advisors work. Robo-advisors typically start by asking investors a series of questions about their financial goals, risk tolerance, and time horizon. Based on the answers, the algorithm creates a personalized portfolio, usually consisting of a diversified mix of stocks, bonds, ETFs, and sometimes real estate or commodities. Once the portfolio is created, the robo-advisor automatically rebalances the portfolio as market conditions change, ensuring that the investments remain aligned with the investor's goals. Advantages of robo-advisors. Low fees. Robo-advisors charge lower fees than traditional financial advisors, making them a more affordable option for those looking to build a diversified portfolio. Accessibility. They make diversification accessible to individuals who may not have the time, knowledge, or resources to manage their own portfolios. Even small investors can benefit from automated portfolio diversification with minimal capital. Hands-off investing. Robo-advisors manage the entire investment process, including rebalancing, tax optimization, and reinvesting dividends, which allows investors to take a hands-off approach. Popular robo-advisors. Betterment. One of the leading robo-advisors, Betterment offers automated portfolio management with a focus on diversification and risk management. It allows investors to create customized portfolios with various investment options, such as socially responsible investing, SRI, or tax-efficient investing. Wealthfront. Wealthfront is another popular robo-advisor that focuses on building low-cost, diversified portfolios. Wealthfront uses tax loss harvesting and other tax strategies to maximize after-tax returns for its clients. Two portfolio management apps. Tracking and optimizing diversification portal management apps have become indispensable tools for investors looking to track their investments, analyze performance, and optimize diversification. These apps are designed to give investors a clear view of their portfolios, offering insights into their asset allocation, risk exposure, and potential areas for improvement. How portfolio management apps work. Portfolio management apps allow investors to link all their investment accounts, e.g., brokerage, retirement accounts, real estate holdings, into one platform. The app automatically tracks the performance of each asset and calculates the overall performance of the entire portfolio. Many of these apps also include features that analyze the asset allocation of the portfolio, ensuring it remains diversified across different asset classes, sectors, and geographical regions. Key features of portfolio management apps: asset allocation analysis. These apps automatically categorize your investments into different asset classes: stocks, bonds, real estate, etc., and provide insights into whether your portfolio is overexposed or underexposed in any specific area. Rebalancing recommendations. Some apps suggest or automatically perform rebalancing to maintain the desired allocation. If one asset class has outperformed and now comprises a higher percentage of the portfolio than intended, this app will recommend adjustments to restore the balance. Performance tracking. Investors can track their portfolio's performance over time, comparing it to relevant benchmarks to evaluate success. This feature helps investors understand how well their diversification strategy is working in terms of returns and risk. Popular portfolio management apps. Personal Capital. This app provides a comprehensive view of your finances, including investment tracking, retirement planning, and budgeting. Personal Capital helps you monitor the diversification of your portfolio and ensures it aligns with your long-term goals. Mint. Mint is primarily a budgeting app, but it also offers investment tracking features by linking investment accounts. Mint allows users to track their asset allocation and monitor the performance of their portfolio, making it a valuable tool for those looking to maintain diversification. Morningstar. Morningstar offers premium investment tracking and analysis tools. It provides detailed breakdowns of portfolio performance, asset allocation, and risk exposure, helping investors manage their diversification strategy effectively. 3. Automated investing platforms. Making diversification scalable. Automated investing platforms are a step beyond robo-advisors in terms of providing scalability and customization. These platforms combine advanced algorithms with human oversight to offer tailored investment strategies that help diversify portfolios across multiple asset classes and sectors. How automated investing works. Automated investing platforms typically allow investors to select a strategy based on their financial goals and risk tolerance. These platforms use algorithms to create a diversified portfolio and automatically manage the investments, including rebalancing and tax optimization. They also provide ongoing analysis of the investor's portfolio to ensure it remains in line with their goals. The role of automation in diversification efficiency. Automated investing platforms handle routine tasks such as portfolio rebalancing and tax loss harvesting, ensuring that diversification is maintained with minimal effort from the investor. Scalability. These platforms allow investors to scale their portfolios without needing to manually manage each asset. This is particularly useful for investors with large, complex portfolios that span multiple asset classes and markets. Data-driven decision-making. Automation allows investors to leverage data from multiple sources, ensuring that decisions about diversification are based on real-time market data and historical trends. Popular automated investing platform. Schwab. Intelligent portfolios. Schwab's automated investing platform creates a diversified portfolio using a mix of stocks, bonds, and cash, tailored to the investor's risk tolerance. The platform also automatically rebalances the portfolio to maintain diversification. Sophie Invest. Sophie's automated investing platform offers diversified portfolios with low fees. It provides access to ETFs, individual stocks, and other investment options, all while automating the rebalancing process. 4. The role of artificial intelligence and machine learning in automated investing. Artificial intelligence (AI) and machine learning (ML) are becoming integral parts of automated investing platforms. By analyzing large datasets and learning from historical market performance, AI and ML can provide deeper insights into the dynamics of a portfolio and recommend improvements to diversification strategy. How AI enhances automated investing. Guide-driven platforms can learn from market trends and investor behavior to optimize portfolios continuously. Machine learning algorithms can assess the correlations between different assets, sectors, and regions, suggesting portfolio adjustments that maintain diversification while also improving risk-adjusted returns. Predictive analysis. AI can predict how different assets will perform based on a variety of market indicators. This allows automated investing platforms to adjust portfolios in real time to better capture growth and manage risk. Adaptive strategies. Machine learning enables automated investing platforms to adapt to changing market conditions. For instance, if a recession is predicted, the platform might adjust its asset allocation to reduce exposure to cyclical industries and increase holdings in defensive sectors. 5. Benefits of automation for diversification. Key benefits of using technology and automation in diversification include cost efficiency. Automated platforms typically charge lower fees than traditional financial advisors, making it more affordable for investors to maintain a diversified portfolio. Time savings. Automation takes the time-consuming tasks of managing and rebalancing a portfolio out of the investor's hands, allowing them to focus on long-term goals rather than short-term fluctuations. Consistency and discipline. Automation helps prevent emotional decision-making, ensuring that investors remain focused on their long-term strategy without getting swayed by market volatility. Conclusion. Technology and diversification in the future. The role of technology and automation in investing is only going to increase as more investors look for cost-effective, efficient, and personalized ways to manage their portfolios. Tools like robo-advisors, portfolio management apps, and automated investing platforms will become essential in maintaining diversification. These technologies offer unparalleled precision, scalability, and the ability to manage risk effectively, helping investors optimize their portfolios and achieve their financial goals. Building a diversified portfolio from scratch is one of the most important steps any investor can take to reduce risk and increase the potential for long-term growth. Diversification involves spreading investments across various asset classes, sectors, and regions to reduce the impact of market volatility. The goal is to protect your portfolio from severe losses in case one particular asset or sector underperforms. Creating a diversified portfolio from scratch may seem overwhelming at first, but it's a straightforward process when broken down into manageable steps. In this section, we'll guide you through the process of building a diversified portfolio, focusing on key considerations like risk assessment, asset allocation, and portfolio rebalancing. 1. Assess your risk tolerance. Before you begin selecting assets, it's essential to assess your risk tolerance, your ability and willingness to accept the fluctuations of the market in pursuit of higher returns. Your risk tolerance will influence the types of assets you choose and how aggressively or conservatively you build your portfolio. How to assess risk tolerance. Time horizon. The length of time you plan to invest will influence how much risk you can take. If you're young and investing for retirement, you can afford to take on more risk. If you're nearing retirement, you'll likely want to focus on preserving capital. Financial goals. Consider your goals, whether they are long-term, e.g., retirement, or short-term, e.g., saving for a down payment on a house. Your goals will impact how much risk you're comfortable taking. Emotional comfort. How do you feel about the potential for losses in your investments? If the thought of losing money makes you anxious, you may have a low risk tolerance and should focus on more conservative investments. Risk tolerance questionnaire. Many robo-advisors, portfolio management apps, and financial planners provide risk tolerance questionnaires that help investors assess their personal comfort level with risk. These assessments help determine the percentage of your portfolio that should be allocated to more volatile assets, e.g., stocks versus more stable assets, e.g., bonds. To determine your asset allocation. Asset allocation is the process of dividing your portfolio among different asset classes: stocks, bonds, real estate, commodities, and cash equivalents. The goal is to spread out risk while maximizing returns based on your risk tolerance and financial goals. Basic asset classes: stocks, equities. These offer the potential for high returns but are more volatile. They're typically best suited for long-term growth. Bonds: fixed income. Bonds provide a more stable, predictable return and are generally less risky than stocks. They're an essential part of a diversified portfolio for reducing overall risk. Real estate. Investing in real estate either directly or through real estate investment trusts or REITs provides both income through rental yields and the potential for capital appreciation. Commodities. Commodities like gold, silver, and oil can act as hedges against inflation and economic instability. They tend to perform well when stocks are down. Cash and cash equivalents. Money market funds and short-term treasury bills offer stability and liquidity, although they provide lower returns. Asset allocation strategies. Conservative allocation. For those with a low risk tolerance, a conservative portfolio may consist of 60% bonds and 40% stocks. This strategy emphasizes stability and income generation over growth. Balanced allocation. A balanced portfolio typically includes a mix of 50% stocks and 50% bonds, offering both growth potential and stability. Aggressive allocation. For those with a higher risk tolerance and a long-term investment horizon, an aggressive portfolio might allocate 80 to 90% to stocks and the remaining to bonds or alternative assets. This strategy is designed for maximum growth, with the understanding that it comes with higher volatility. Adjusting for risk tolerance. Asset allocation should reflect your risk tolerance. If you are young and have a higher risk tolerance, you may allocate more to stocks and other growth assets. If you are older or risk-averse, you may choose a higher proportion of bonds and cash equivalents to protect your wealth. 3. Choose specific investments. Since you've determined your asset allocation, it's time to choose specific investments within each asset class. Here's how to go about it. Stocks and equities. Individual stocks. If you prefer to pick individual stocks, ensure that they are diversified across various sectors, such as technology, healthcare, finance, and consumer goods. Investing in a few stocks from different industries reduces the risk of sector-specific downturns. Exchange-traded funds. ETFs. ETFs allow you to invest in a broad basket of stocks, offering instant diversification within a specific sector. Index, e.g., S&P 500, or geographic region, e.g., emerging markets. ETFs typically have lower fees than mutual funds and are traded like stocks. Mutual funds, like ETFs. Mutual funds pool investors' money to invest in a diversified group of stocks, bonds, or other assets. Mutual funds are actively managed by professionals but may have higher fees than ETFs. Bonds and fixed income. Government bonds, U.S. Treasury bonds, municipal bonds, or government bonds from other stable countries are relatively low-risk investments. Corporate bonds. These tend to offer higher returns than government bonds but come with slightly higher risk. Choose bonds from well-established, financially stable companies. Bond ETFs or mutual funds. If you prefer not to pick individual bonds, bond ETFs and mutual funds provide diversification across many bonds, reducing exposure to the risk of any one bond issuer. Real estate. Real estate investment trusts. REITs. REITs are an excellent way to gain exposure to real estate without the need to buy physical properties. They offer a high dividend yield and can help balance a portfolio with stable income-producing assets. Direct real estate investments. For those with more capital and experience. Direct real estate investments, e.g., purchasing rental properties or commercial properties, provide the opportunity for both income and appreciation. Commodities and alternatives. Gold and precious metals. Gold is considered a safe haven asset during times of economic uncertainty. It can be purchased directly, e.g., gold coins, or indirectly through ETFs and mutual funds, oil and natural resources. For investors seeking higher risk and potential rewards, investing in oil, natural resources, or agricultural commodities can provide portfolio diversification. Cryptocurrency. While highly speculative, cryptocurrencies like Bitcoin and Ethereum have gained popularity as alternative investments that can provide diversification outside traditional assets. 4. Rebalancing your portfolio. Once your portfolio is set up, regular rebalancing is necessary to maintain your desired asset allocation. Over time, some assets will perform better than others, leading to a shift in the portfolio's balance. For example, if stocks perform well and increase in value, they may represent a higher percentage of your portfolio than intended, increasing your overall risk exposure. How to rebalance. Rebalancing involves adjusting your portfolio by selling assets that have outperformed and buying those that have underperformed, bringing the portfolio back in line with your original asset allocation. Many robo-advisors and portfolio management apps automatically handle this for you, but you can also rebalance manually. Frequency of rebalancing. You should rebalance your portfolio at least once a year, or whenever there's a significant change in the market or your personal financial situation, e.g., a large windfall, retirement, or change in risk tolerance. Tax considerations. Keep in mind that selling investments in taxable accounts may result in capital gains taxes. Consider using tax-efficient strategies, such as tax loss harvesting or rebalancing within tax-advantaged accounts like IRAs. 5. Review and adjust your strategy over time. A diversified portfolio is not a set-it-and-forget-it investment strategy. Over time, your financial goals and risk tolerance may change, as well as the economic landscape. Regularly reviewing and adjusting your portfolio ensures it stays aligned with your objectives. Life changes. Major life events, such as marriage, the birth of a child, career changes, or retirement, may necessitate adjustments to your asset allocation and investment strategy. Market conditions. Market conditions and economic shifts can also require adjustments to your portfolio. For instance, if inflation rises significantly, you might consider increasing your exposure to inflation hedging assets like commodities or real estate. Building a diversified portfolio for long-term success. Building a diversified portfolio from scratch requires careful planning and thoughtful decision-making. By assessing your risk tolerance, selecting the right mix of assets, and regularly rebalancing your portfolio, you can create a strategy that minimizes risk and maximizes long-term growth. Whether you're using traditional investment strategies or embracing new technologies like robo-advisors and ETFs, the key to successful diversification is maintaining balance, discipline, and consistency over time. Common mistakes to avoid in diversification is often touted as one of the best ways to manage risk and maximize returns over the long term. However, achieving effective diversification is not always as simple as spreading your investments across a range of assets. Many investors make critical mistakes that can undermine the benefits of diversification, leading to poor returns, unnecessary risk, and lost opportunities. In this section, we will identify and explore the most common mistakes that investors make in their diversification strategies and provide practical advice on how to avoid them. 1. Over-diversification. Spreading yourself too thin. While diversification is a key strategy for reducing risk, over-diversification can be equally detrimental. Over-diversification occurs when an investor holds too many different assets in their portfolio, leading to a dilution of potential returns. It can happen when investors spread their capital too thinly across a large number of investments, making it harder to see meaningful gains in any one asset. Why over-diversification is a problem. Diminished returns. When you over-diversify, the strong performance of a few assets may be counterbalanced by the poor performance of others. This can lead to lower overall returns, as the gains from the top-performing assets are absorbed by the underperforming ones. Complexity and management issues. Managing a highly diversified portfolio can become complex and time-consuming. Regular monitoring and rebalancing become more difficult as the number of investments increases and it can be hard to track all the assets and maintain the correct balance. How to avoid over-diversification? Focus on quality, not quantity. Instead of filling your portfolio with as many assets as possible, focus on selecting high-quality investments that complement each other and align with your long-term goals. Limit the number of investments. Aim for a reasonable number of investments, generally between 10 to 30 stocks or assets across different sectors and asset classes. Adding more assets won't necessarily improve returns but may add complexity without sufficient benefit. Point 2. Lack of rebalancing. Failing to adjust over time. Another common mistake in diversification is failing to rebalance your portfolio regularly. As markets fluctuate, the weightings of different assets in your portfolio will change, and you may end up with an allocation that no longer aligns with your risk tolerance or financial goals. Why rebalancing is critical. Shifts in market conditions. When one asset class outperforms or underperforms, it can throw off the intended balance of your portfolio. For example, if the stock market rises significantly, the stock portion of your portfolio might become too large, increasing your exposure to risk. Maintaining your risk profile. Rebalancing ensures that your portfolio stays aligned with your desired risk-to-return ratio. Without regular adjustments, you may inadvertently take on more risk than you're comfortable with, or you may miss opportunities for growth. How to avoid the mistake of failing to rebalance? Set a rebalancing schedule. Rebalancing should be done at least once a year, or whenever there's a significant shift in your financial goals, risk tolerance, or market conditions. Automate the process. Many robo-advisors and portfolio management apps automatically rebalance portfolios for you, ensuring that your asset allocation remains consistent without requiring constant attention. 3. Under-diversification. Putting all your eggs in one basket. While over-diversification is a risk, under-diversification can be even more harmful. Under-diversification occurs when an investor concentrates their portfolio in just a few assets or sectors, which significantly increases the risk of large losses if those assets perform poorly. Why under-diversification is a problem? Higher risk exposure. When you hold a small number of investments, the performance of just one asset or sector can have a disproportionate impact on your portfolio. For example, if you invest all your capital in technology stocks, a downturn in the tech sector could lead to significant losses. Missed opportunities for growth. By focusing too narrowly on a few assets or sectors, you may miss out on growth potential in other areas of the market. How to avoid under-diversification? Diversify across asset classes. Make sure your portfolio includes a mix of stocks, bonds, real estate, commodities, and cash equivalents to spread risk across different types of investments. Include international investments. Don't limit yourself to domestic markets. Consider adding international stocks or emerging market assets to further diversify your portfolio and reduce exposure to risks tied to one country or region. 4. Focusing too much on past performance. Of the common mistake in diversification is chasing past performance. Many investors make the mistake of buying into assets or sectors that have performed well in the past, assuming that their success will continue indefinitely. While past performance can provide some insight, it is not a guarantee of future returns. Why this is a problem? Risk of overconcentration. By focusing on past winners, you risk overconcentrating your portfolio in a single asset or sector, which could lead to higher volatility and risk. Ignoring changing market conditions. Market conditions are constantly evolving, and what worked well in the past may not be effective going forward. For example, tech stocks may have experienced explosive growth in recent years, but that doesn't mean they will continue to perform well in the future. How to avoid this mistake? Use a long-term perspective. While past performance can help inform your decisions, it's important to focus on fundamentals, diversification, and long-term goals. Don't get caught up in short-term trends or hot sectors. Consider market conditions and risk factors. Always evaluate investments based on their current market conditions, growth potential, and how they fit within your overall portfolio strategy, rather than solely relying on their historical performance. 5. Ignoring tax implications of diversification. Tax implications can significantly affect the returns of a diversified portfolio. Many investors overlook the tax efficiency of their investments, which can lead to unnecessary tax liabilities and reduced returns. Why tax efficiency is important: capital gains taxes. Selling assets that have appreciated in value may result in capital gains taxes, which can reduce your overall returns. This is particularly relevant when rebalancing your portfolio. Tax-efficient investment accounts. Certain accounts, such as IRAs or 401ks, allow for tax-deferred growth or tax-free withdrawals, which can help you keep more of your returns. How to avoid tax mistakes in diversification: use tax-efficient strategies. Consider holding income-generating assets, such as bonds or real estate, in tax-advantaged accounts, e.g., IRA letters or 401ks. This can reduce the tax burden on your investments. Tax loss harvesting. This strategy involves selling underperforming assets at a loss to offset capital gains from other investments. Many robo-advisors and portfolio management platforms offer tax loss harvesting as part of their services. Consider asset location. The location of your investments matters. For example, placing stocks which may appreciate significantly in tax-deferred accounts and bonds which generate regular income in taxable accounts can help optimize your tax situation. *6. Failing to stay disciplined during market volatility. Market volatility can trigger emotional responses, and investors often make the mistake of reacting impulsively during periods of market turbulence. This might involve selling off assets or making drastic changes to the portfolio in response to short-term market fluctuations. Why emotional decision-making is a problem. Loss of diversification. Reacting emotionally during market volatility may lead you to abandon your diversified strategy. For example, if stocks are performing poorly, you might sell them off, leaving your portfolio exposed to other risks. Timing the market. Trying to time the market is notoriously difficult and often leads to poor investment decisions. Research has shown that investors who sell off assets during downturns often miss out on subsequent market recoveries. How to stay disciplined during volatility. Stick to your long-term strategy during market downturns. Remind yourself of your long-term goals and the benefits of a diversified portfolio. Short-term volatility is normal, and staying the course will help you ride out the ups and downs. Rebalance and review periodically. Regularly reviewing and rebalancing your portfolio can help you stay focused on your long-term strategy and avoid making emotional decisions during market fluctuations. Conclusion. Avoiding common diversification mistakes. Effective diversification is critical to managing risk and achieving long-term investment success. However, common mistakes such as over-diversification, under-diversification, failing to rebalance, and focusing too much on past performance can undermine the effectiveness of your strategy. By staying disciplined, focusing on quality assets, and regularly reviewing your portfolio, you can avoid these pitfalls and build a diversified portfolio that supports your financial goals. Final thoughts on diversification. Cornerstone of successful investing. Through this series, we've covered the many facets of diversification, from understanding its core principles to implementing it in modern portfolios with the help of technology. Diversification is the bedrock of sound investing because it helps investors manage risk while maximizing potential returns, whether you're a novice or an experienced investor. The lessons of diversification remain as relevant today as ever. In this final section, we'll recap the key insights we've gained and offer practical advice on how to implement diversification strategies to build a resilient, well-balanced portfolio that aligns with your financial goals. Key takeaways from the serialettes. Quickly review the core concepts we've covered and why they are vital for successful investing. 1. Diversification reduces risk. Primary reason to diversify your investments is to reduce unsystematic risk. The risk specific to individual stocks, sectors, or companies. By spreading your investments across various asset classes, industries, and geographical regions, you reduce the likelihood of large losses if one asset or sector underperforms. 2. The importance of asset allocation. Your portfolio's asset allocation. How you distribute your investments across different asset classes, stocks, bonds, real estate, etc., is the key to managing risk and achieving growth. The right allocation depends on your risk tolerance, time horizon, and financial goals. Whether you're aiming for aggressive growth or more stable, conservative returns, asset allocation ensures that your investments are aligned with your personal financial objectives. 3. Strategic diversification across sectors and geographies. Diversification involves more than just owning different stocks. You must consider diversifying across sectors: technology, healthcare, energy, etc., and regions, domestic and international markets. This reduces exposure to any single economic or geopolitical event that could affect one sector or country. 4. Behavioral biases can undermine diversification on emotions such as overconfidence, loss aversion, and herding behavior often lead investors to make irrational decisions. These biases can prevent investors from diversifying effectively, causing them to concentrate in a few assets or sectors. By recognizing and addressing these biases, investors can make more rational decisions and stay committed to their diversified strategy. 5. Technology and automation are changing diversification. Technologies like AI, machine learning, and robo-advisors have made it easier than ever to build and maintain a diversified portfolio. These tools help investors make data-driven decisions, automate portfolio management, and adjust their portfolios in real time to reflect market changes, all while minimizing costs. 6. Rebalancing is key to maintaining diversification. A diversified portfolio is not static. It requires regular monitoring and rebalancing to ensure that it continues to meet your risk and return goals. Over time, some assets will outperform while others lag behind, leading to shifts in your portfolio's overall allocation. Rebalancing ensures that your portfolio stays aligned with your original diversification strategy, protecting against overexposure to any single asset. Practical steps for implementing diversification. That we've reviewed the key principles of diversification, let's focus on how to practically apply them to your investment strategy. 1. Set clear financial goals before you start building your portfolio. It's essential to establish clear financial goals. Are you investing for retirement, a down payment on a house, college tuition? Understanding your goals helps define your investment horizon, short-term or long-term, and influences your risk tolerance. The more specific your goals, the easier it will be to tailor your asset allocation and diversify accordingly. 2. Assess your risk tolerance. Once you know your financial goals, assess your risk tolerance. If you're unsure about your risk profile, many online tools and robo-advisors can help you determine whether you're conservative, moderate, or aggressive in terms of your risk preferences. This self-assessment will guide your asset allocation decisions, helping you strike a balance between risk and reward. 3. Diversify across asset classes, stocks and equities. These will be the growth engine of your portfolio, but they come with higher risk. Focus on a mix of large-cap stocks, mid-cap stocks, and international equities to ensure broad exposure to different market segments. Bonds act as stabilizers in a portfolio. They provide income and tend to be less volatile than stocks. Include a mix of government bonds, corporate bonds, and municipal bonds to diversify within this asset class. Real estate and commodities. Both real estate and commodities, e.g., gold, oil, can hedge against inflation and provide diversification outside traditional asset classes. Consider rights for exposure to real estate and gold or other precious metals as safe havens. Cash and cash equivalents. Keep some liquidity in your portfolio for emergencies or opportunistic investments. Cash equivalents like money market funds or short-term treasury bonds can help balance risk. 4. Diversify geographic linking. Only in your home country can expose you to localized risks. By investing in international stocks or emerging markets, you can tap into growth opportunities in different parts of the world while reducing reliance on the performance of your domestic market. 5. Use low-cost ETFs and mutual funds. Exchange-traded funds. ETFs and mutual funds provide easy, low-cost access to diversified portfolios. By investing in broad market index funds or sector ETFs, you gain exposure to a wide range of assets without needing to pick individual stocks or bonds. Additionally, many funds are available that focus on socially responsible investing or other niche strategies, allowing you to align your portfolio with your values. 6. Automate where possible. Automation can save time and reduce the risk. of emotional decision-making, many robo-advisors, apps, and platforms allow you to set up automated investments and rebalancing. This ensures that your portfolio remains diversified without needing constant attention. 7. Regularly rebalance your portfolio. Finally, regularly rebalance your portfolio to maintain your desired asset allocation if one asset class, e.g., stocks, outperforms while others lag. Your portfolio may become unbalanced with too much exposure to riskier assets. Rebalancing ensures that you stick to your long-term strategy and avoid taking on more risk than you're comfortable with. Challenges in diversification. Why diversification is a powerful strategy. There are challenges to consider. Over-diversification can lead to poor returns, market conditions can change rapidly, and diversification may not fully protect against large-scale market crashes. Costs and fees associated with managing a diversified portfolio can reduce returns, especially if you use a lot of ETFs, mutual funds, or robo-advisors. However, with the right approach and proper tools, these challenges can be mitigated, allowing you to build a resilient portfolio. Conclusion: diversification as a lifelong strategy. Diversification is not a one-time decision but a lifelong strategy that requires ongoing attention and adjustments. By understanding the core principles of diversification, applying them to your investments, and staying disciplined during market fluctuations, you can build a portfolio that minimizes risk and maximizes potential for long-term growth. Thank you for watching and joining me on this journey into the world of diversification. Whether you're a seasoned investor or just getting started, I hope this series has provided you with valuable insights and practical strategies to help you build a resilient, diversified portfolio. Remember, investing is a long-term commitment, and with the right approach, you can manage risk while maximizing your potential for growth. Don't forget to hit that subscribe button for more content like this. And feel free to leave any questions or thoughts in the comments section below. I love hearing from you. Until next time, stay informed, stay diversified, and happy investing.